Hey everybody, Scott here. I am excited for a special episode of the Wealthy Pilot podcast today. I have normally we have Mark here co-hosting, but today I get to be the co-host. And I have two special guests with me today, Brian Moody and Hans Tooey. And these two gentlemen are from Remnant Finance. They're also both current and former pilots. So I would like to share a little bit about what they're going to talk about, and then we'll dive right in. So today's topic is the infinite banking concept. And we have a ton of great information. This is something that has been out there. You probably heard about it in the cockpit before, and I get a lot of questions about it. And I'm really thankful to have crossed paths with these two guys and their expertise, and being able to share a little bit of this great information with you guys today. Now, they are the co-founders of Remnant Finance. Hans is a former Navy H-60 Seahawk pilot. Brian is a current KC-135 Pennsylvania Air National Guard pilot, also an FO with American Airlines on the 737. So, gentlemen, thanks for being here today. Appreciate your time. And I'll let you guys give a little introduction about yourself, and then we're going to dive right in. So, Hans, let's start with you.
Hey, thanks, Scott. Yeah, great to be on. I'm, like you said, former Navy pilot. I kind of had an awakening on a lot of fronts. 2020 timeframe, the mandate essentially ended my career flying, and it's a long story, but it's led me to here. I had to relearn everything I thought about the military, medicine, the legal system, and then that led to the financial system. I've been a big student of personal finance. I've been a huge advocate of the kind of the financial planning model for my entire career. And I started to rethink my thinking on how I was planning for myself and my family. And I came across this concept through Brian. Brian introduced me to it in the midst of our fight against the DoD in the mandate. And it took me a while to come around to it. I came around to it by trying to stress test and poke holes in it and prove that there's no way this worked. There's no way that this would improve what I was doing. And by trying to dive into it and discredit this idea, I came around to the realization that this was the foundational place for me to store and save my capital. And we will get into the protect, save, grow order of operations that we like to talk about, and where we position ourselves versus where you position yourself, and how we kind of have this symbiotic relationship of things that we're all trying to do. But I'll cut it off there because I don't, I want to. I have a tendency, if you listen to our podcast, to run and find the podcast a monologue, and I'll cut it short here.
Yeah, that's all good. So, all right, Brian, you're up.
Yeah. Hey, background. I'm, Christian father, husband, got 4 kids here in Pittsburgh. I've been here in Pittsburgh the whole time. So I've always flown for the Guard here. Same thing. Hans and I met in the mandate. So we both fought the COVID vaccination, the illegal mandate there. And he was talking about a book called Creature from Jekyll Island. And I said, hey, if you've read that, then you should read this, Become Your Own Banker. So that's kind of how we partnered up over time, like he said, and finally he came back to it, became a client of mine, and ultimately a partner in the business. I had this business going under a different brand prior for a couple years. So I found this in 2018 on a deployment. The book just kept appearing in my recommended reading in Amazon. So finally I clicked on it because it sounded hokey to me, to be honest, like Becoming Your Own Banker. What the heck does that mean? But then I just read it and it blew my mind, shifted my whole paradigm from kind of a Dave Ramsey style investing that way and thinking that way to thinking about the need for capitalization and the need to take over the banking function in your life. So yeah, excited to be here, man. It's a pleasure. It's an honor. And just to be clear, like I'm a client of yours with my my investment stuff. So that is how we met originally. Real happy with that service. And we started talking about finance. And since we do totally different things, how those things kind of can work together, and linked up and became friends. So awesome to be here on the show.
Yeah, no, I appreciate it. It's always good to find those complementary, lines of service that meet the needs of clients with all the different things that they have going on. So, I love it. I love this discussion and thought around the infinite banking concept. We tend to think of money in finite terms, right? I mean, anything we're buying, a contract, anything we're doing, it's got to start and an end to it. And a lot of what we talk about, on that estate planning discussion is like building that legacy out. And so when we talk about building the legacy and starting to leave a legacy, and that's when you start to get into something that is generational. And, we can start talking about this infinite banking concept. So with that said, let's kind of hop in and define it. Like, what does that mean? Infinite banking concept and becoming your own banker. What does that even mean?
Well, there's the words there are very particular and very carefully chosen by Nelson Nash, who was the author of the book Becoming Your Own Banker that I kind of referenced there for a moment. And you can get a copy of that at remnantfinance.com or wherever you want. You can find a copy, but it's absolutely essential reading for this concept. So infinite, like it's about imagination, reason, logic. So what can you do when you have a pool of capital? It's infinite. What can you do? How long should you be thinking? You should be thinking long range. Now, it's impossible for us it's not totally impossible, but it's hard to think in an infinite time perimeter. It's even hard to think it multi-generationally, although that's important. The banking concept is something that everybody should be, but is vaguely not really familiar with, actually. And it's the fact that everybody there's one pool of capital in the world, and everything's going to flow to it. It flows through us. It flows through everybody else. There's only one pool, but where can we access that? And can we build our own reservoir to take over the banking function? So the loaning, the borrowing, the storage of money is something everybody does, or the flow of money, even if you don't store it. Even if money comes into your life and it goes right out, you're still participating in the banking function.
Right.
So how can we become the benefactors of that rather than let the banks be the benefactors and the outside lenders and the other people that store that money? So there's two main problems that this solves. One is that in America, we have an abysmal savings rate. We're the wealthiest nation in the world, and on average, it's about 4%. People just aren't storing money, and especially storing money that they have access to and can utilize to benefit their own lives.
And just so I'm understanding that, is that so? For every $100,000 a person makes, they're saving for.
They're saving, and we need to really speak differently. So when we're talking about the infinite banking concept, it is not an investment. His book makes that clear. It's in the first paragraph. We are not talking about an investment. We are talking about the storage and utilization of capital. We're talking about saving. So the savings rate is 4%.
Yeah.
It's nuts that it's that low.
Yeah.
And then that leads to the second problem, and that is that we finance everything we buy. Every single thing we buy, from a house to a piece of gum. Because there's only two ways to do things. You either borrow money and you pay interest to an outside entity of some sort, or you use your own cash and you give up the interest that money could have earned. And there's no exceptions. So ultimately, you're financing that by not earning money on your money. Infinite
opportunity cost, in essence. Right?
Exactly. It's an opportunity cost. Perfect. So the infinite banking concept solves for those two problems. I'll let Hans jump in and add to that.
Yeah, I mean, money is just it's a form of energy to acquire the things we want. It in and of itself is not valuable. It's what it can do for us. And so money comes into our life and money flows out. And most people, you get a raise, you get a bonus, and then you fast forward a year and you say, where did it all go? Because we're not conscious about the money flows in. We don't harness it. We don't protect it. We need to focus and our mantra, protect, save, grow. We want to focus on, and what Brian and I focus on is not the growth aspect of it. That's your specialty. We focus on how do we harness and build this economic potential energy. So like you got a river that's flowing. It's going to flow no matter what you do. It's going to go in, it's going to go out. You can go to the river, you can catch a fish, you can get a cup of water, you can get water for your appliances, whatever. Or you could build a windmill on it and you could actually, take advantage of some of that. And that's kind of what people do if they're following, financial advice. Like you're building a windmill, you're channeling the power of that. But what we really want to do is we want to put a dam on there and actually control the outflow. If you think of your financial life as a leaky bucket, most of us have this bucket where water flows in, the money flows in, but then it just goes out. And so we're trying to build this dam so that we can build like a warehouse or a reservoir, as Brian said, for this economic potential energy, because that's all money is if it's stored and harnessed. And by locking it, not by storing it in this contract that has these guaranteed, legally protected rights and guaranteed growth that we can then leverage. We can do all the things we want to do. We can do our investments. We can do real estate. We can do all these things from a protection and savings foundation. It's kind of another analogy is like we build a castle, we build a moat around it, and then from there, from that position of strength, we go out into the field and take risks and invest and grow.
Yeah.
But we want to make sure that we're not just kind of aimlessly out there conquering with nothing to fall back on in case things go wrong. Like we want to build and protect that castle first. And without getting into any details about the actual process or the product or anything like that, just keeping it high level, that's sort of philosophically how we approach the acquisition and retention of capital that flows into our life.
Well, I know kind of going through this process with you guys, a big part of it that has really opened my eyes and made me a believer of it is reframing, because again, the product that we're using here is going to be a properly structured whole life insurance policy. And it's reframing my mindset, the consumer's mindset around what are we using that policy for? And it's looking at, like you just talked about, the savings rate. I mean, $4,000 out of every 100,000 that someone's making. And you talked about the leaky bucket of our income. Man, I cannot tell you how many times, especially when we're doing a retirement plan for somebody, and we're like, okay, well, how much do you spend a month? And they're like, probably about $8,000 a month. Okay, you spend $8,000. What's hitting the checking account every month? About 20. Okay, so you have 12,000 left over every month. No, not even close to that. That's a leaky bucket right there. But I mean, without fail, 100% of the people we talk to, we really lose track of our spending. And that leads us to, behaviorally not engage in the right habits from a saving perspective. And, Brian, you brought up Dave Ramsey earlier. And one of the things that always grinds my axe with some of his teachings. Now, I'm a huge fan of a lot of his teachings for many, many people. I think he's done way more good than harm in the world for sure. But when we look at people who are making really good money and able to make, good debt management solutions, good financial decisions around what they're purchasing their home and the investments they're doing and all those kind of things. Some of his advice, I think, maybe is a little rudimentary for what some of our clients, a lot of my clients really can unlock. And one thing that comes to mind is this discussion around the average car payment Dave always talks about. Man, if average car payment $647 a month. If I put that in the market and compound it at 10% the next 30 years, I'm going to have $4 million. But he's never acknowledging, well, do I ever get to buy am I ever going to need a new car in that next 30 years? Like, there's never that discussion of like, you still have to save somewhere and do something to get another car. If you invest all of that savings that Dave's teaching, you're still never going to actually save for a car. And so that's where I think this solution, I'm excited for you guys to get into a little bit more detail on it, has really opened my eyes to the opportunity to bring savings into our control and compound that on our behalf of our entire lives for all the things that we buy. So I like some of those, just kind of hitting some of the problems, right? When we talked about the savings rate, let's talk a little bit about finance. I know in the book, you guys had me read too, the average amount of our income we're spending on financing is what, 34% on average over our life?
Nelson Nash wrote that in the book, and he studied like the typical American's behavior for a couple decades and found that the number barely fluctuated from there. Is that people are financing and paying interest on about 34.5% of their income is paid to outside institutions ultimately. And that's when you look at, that's not an interest rate. Yeah. That's a volume of interest.
Yeah.
So that's how much of their money ultimately ends up in the hands of the banks when they finance the things they do in their life, which is astronomical. Most people don't think about that. But if you think of a typical mortgage, especially right now when they're 7-8%, those first payments is 90 something percent. I don't know the exact number, but it's in the 90s in the beginning is all interest.
Yeah.
You're not paying 7% interest and 93% principal every month. So yeah, you have a 7% interest rate, but the volume of interest over a course of a person's life works out to somewhere between 30 and 35% just going to an outside bank, just going to the credit card companies, just going to the credit union, wherever that is. And that's a big problem. So infinite banking helps control some of that because we can start getting that interest working in our lives.
Now, how do we make that switch where the interest, instead of going to the bank, starts to come towards us? How does most folks are not going to think a whole life insurance policy is going to be the solution to get interest working on my behalf.
Well, that's where we got to get down to what can we actually do with capital? Like I mentioned earlier, if we effectively harness and control the capital that flows into our lives, whether that is in a savings vehicle like we're talking about or an investment vehicle like you set people up with, if we effectively capture that capital that flows into our life at a certain point, like we don't just want the capital for capital's sake. We don't just want dollars for dollars' sake. We want them to acquire goods and services, acquire the things we need to live. Like that is the ultimate end goal. So when we have that effectively harnessed, we only can really do two things with it. We can either liquidate or leverage, right? And so if you have a product that requires, like for instance, a security, whether that's a retirement account, it could be a brokerage account, stocks, whatever. You don't just want Apple stock for Apple stock's sake. You want Apple stock so that one day you can liquidate it, take the proceeds as income, and then deploy it, like to get the goods and services you want, right? So there's assets you can liquidate, and there's assets you can leverage. And technically, the world of the realm of products, financial products that you can leverage a stock technically in a margin account. You can leverage a lot of different products. When we're talking about the contractual rights in a whole life policy, without going into too much detail, we have the contractual right to leverage that, so where we can put our dollars to work in more than one place. And so we can call it the multiplication effect, where dollars are, one, your savings dollars are growing, but you can access them by leveraging them without actually depleting your principal. And so you can have your dollar, I don't want to get too in the weeds here, but yeah,
I wanted to add to that, but while you're thinking about it, is we structure, like you said earlier, Scott, that these are specially designed, or they have a particular design for the infinite banking concept. We structure these in such a way that we don't give up any of the guarantees, any of the efficiency, anything in the contract, but we structure them in a way that they have a higher cash value component. So a cash value is just like equity in a home. So every time you make a payment in a home, you get a little bit of equity, but it's really small, like I just referenced when I last spoke. It's tiny in the beginning. We build these so that the policy is essentially getting high equity fast. Now that equity, it's called cash value, and that is a contractual value of your policy. So think of it this way, to like, just to make like an analogy, because it's not actually a bucket of cash sitting somewhere. It's a contractual value of that policy. But like, let's say there's some money that you've built up the way we design these quickly, and there's $50,000, and you want to go buy a $30,000 car. You have two choices. You have a couple choices. You could just spend cash. You could finance it somewhere. We are going to finance it. We're going to finance it with the insurance company. So we go over here to the insurance company's bucket of money. It's called their general fund. And we ask them, we want a loan for $30,000. They're not going to do any underwriting. They're not going to ask us what it's for, why we want it. They're just going to look and see if our contractual value has at least $30,000. It does. So they send us a check, sometimes overnight, sometimes it takes a week, little bit of 3 to 5 days, typically business days, you get this check in the mail or deposit into your account. Now, what they did was they put a lien on your $50,000 for that 30. All of that value is still attached to your contract, and it still grows interest, guaranteed, and it still gets the dividend payout when the company's profitable. All the companies we use have been profitable for 120 plus years.
Wow.
Have always paid a dividend.
Yeah.
So now you're paying an interest rate to the insurance company, but your money has not stopped growing at interest and dividends. So when you do that for everything, when you get to a point that you've capitalized this system, and you've capitalized it with, you haven't been afraid to capitalize it. You've paid high premium for those who can do it. And that's all relative. If you're 18 and you got your first job, high premium could be a couple grand a year.
Yep.
If you're a captain at the airline making a few hundreds of thousands of dollars, it's going to be a much higher capitalization effect that you're capable of doing. So what you put in with what you get out. But now your money is growing here, even while you're using it to buy that car. So you've mitigated that opportunity cost of paying cash. And ultimately, if you think about the long-term wealth, that parabolic curve that we always look at when we talk about wealth over time, doing that over and over and over, is you could buy 10 cars of your life. That 30,000 will become 250,000 over 50 years.
Right.
And you still would have bought 11 cars, You would have just done it differently before.
Well, and that's not even, when we talk about some of the power of compound interest, we're not even talking about the fact that you're financing a depreciating asset.
Mm-hmm.
I'm taking capital. I mean, the $30,000 car is a perfect example. I'm taking that $30,000. What could I do with it? I could invest it in the market. Hopefully I'll go get 10+% there. I could, keep it sitting in the bank and earn close to nothing, and then go finance the $30,000 car and pay, 7%, 8% interest on that. Or I can pull it out of this cash value policy, and I pull it out of that policy, and that $30,000 still shows on my balance sheet as capital. And it's going to continue to grow and compound with the dividends uninterrupted while I'm using that $30,000 to go pay cash for a car, in essence.
Yep. And and then you're going to be honest and you're going to make those repayments. So then it works like a line of credit.
Yeah.
Every repayment on the car you make, that's again available to you. You're just refunding that pot. They're just lowering the lien against your value essentially. So it works like a line. It works very similar to a HELOC or something along there, or a business line of credit or a personal line of credit.
But it sounds like, because I feel like 2022 was a year that a lot of people learned a lot of valuable lessons around HELOCs, which was this thing sat at 0.25% interest forever. I could write checks on it, whatever, go pick up a couple overtime trips, pay it off, no big deal. Well, next thing you know, you're putting a $100,000 pool in, write the home equity check, boom, there it is. Well, in 2022 came along and rates went from 0.25 to 9.25 in about 6 months. And all of a sudden you're paying $2,000 a month in interest. So,
and they can pull that, they can call that note whenever they want. They control the terms. What we're talking about, becoming your own banker, we're not becoming a licensed banker. We are just controlling the banking function, which happens for all of us, whether we know it or not.
Yeah.
And so when we talk about, understanding like the financial physics at play here, if we think about what a bank is doing, if I have my money sitting in there in my high yield savings account earning 4% right now, and you, Scott, go and take out a car loan at 8%, they're using my money that they're paying me 4% on, and you are borrowing my money and paying them 8%, right? And so the source of capital is my capital for them, but the profits go to them. And so that's not a 4% difference. That's 100% different. For every dollar that they're paying me, they're getting 2 from you. That is 100% rate of return. And then without even getting into fractional reserves, and they're doing that 10 plus times on my money that's sitting in the high yield savings account, just at a 1-for-1 level, I put in $1,000 and they pay me 4%, and then you borrow that $1,000 and pay them 8%. They are doubling their money. And so we just need to understand, we need to think like a banker, and we need to do what banks do. Banks don't just set it and forget it. They're not just in it for the long run. They don't just, buy no matter what the market's doing and just leave it in there for as long as possible and hope that it's there in 30 years. Like they are actively reducing their risk down to nothing. If you take out a mortgage, they don't say high risk equals high return. They don't look at a risky borrower. I mean, in 2008 they were, prior to that they were, but they're not just going to look at, a broke college student and say, hey, this guy's a high risk, but if we give him this mortgage, it could be a high return for us. No, they say, you want to borrow $100,000 for a mortgage, you're going to collateralize 130, right? They're leaving themselves no risk because they understand the financial physics. We're just trying to play by their rules and understand the rules is the big thing. Like we need to understand some basic tenets of how banks operate and how they're profitable. And then when we explore ways like the infinite banking concept, that we can kind of step in and interject ourselves and control that flow of capital, because the flow of capital is happening no matter what. Someone, whoever's listening to this, we know 2 things about you. You're going to die one day. And we also know that someone is profiting off of the flow in and out of your personal economy. Someone is currently profiting off of that. I know that about you. And so if we can take that guaranteed event of your death, match it with this guaranteed outcome of a tax-free estate to your family to compensate for them, and then in the meantime, from now until that day comes, capture that the value of the flow of money in and out of your life that someone is currently doing, whether that's you or somebody else. Like, we're just trying to do what the banks are doing and understand those principles.
Yeah. Yeah. No, that's great. And, it leads me to think of getting maybe a little bit more detailed. We talked about a properly structured whole life cash value insurance policy. There's many different kinds of life insurance out there. Most people are familiar with term insurance, but I've also seen a lot of, at this point, now that I'm enlightened, I would say I feel like I've seen other, what I would call misinformation campaigns on other styles of life insurance policies that I feel like make these same claims. And I've looked into these policies before. And after these claims have been made, you start to look at, and I think one of the biggest things that I would like you guys to maybe talk to a little bit with some of these other universal kind of policies is the lack of guarantee. And a big reason I was never a huge advocate of those kind of policies is because already in my world, I mean, you'll go to jail if you make guarantees in my world, because we can't guarantee anything out there on the gross side of the spectrum. And so, what I like about the policies that you guys run for folks is those guarantees, but talk a little bit about some of those maybe like poorly designed policies out there and some of the mistakes and that maybe other agents might be leading their clients along and what we would do to avoid those.
Yeah, well, I would say that, in the financial world, there aren't necessarily bad products. There's bad products for certain purposes. And so I would never sell a universal life contract, and I would never sign one for myself or my family. I don't think it's a good product for me or probably for most people, but in some certain situations, it might be okay. The problem with it when we're talking about taking over the banking function is we utilize whole life insurance from a mutual company. That means you're a part owner, and as a part owner, they're gonna share the distributions of the profits with you in the form of a dividend. But they come with absolute guarantees, contractual guarantees, contracted. It's under law. They have to give this certain amount. So in a universal life contract, it does not come with the same guarantees. And the reason is the way it's constructed, the basic reason. And we could really get in the weeds, but if we keep it basic, a universal life policy that people try to do this process with, and the founder of this process said never use universal life for it. But is that they build it on this chassis of what's called annually renewable term life insurance, which means every year you're closer to death. So on an actuarial basis, it's more of a risk to insure you every single year. Every year you wait to get life insurance, it's more expensive. And so this is going to go up in price over time. It has to. And they'll even lock in a guaranteed rate, kind of like a term insurance rate. They're all structured a little differently for a period of time where that insurance cost doesn't go up, but eventually it will. And so when that goes up, while they'll tie your cash value side of this to the market, depends. There's different types of universal life policies. Let's talk about index universal life. They'll tie it to the market. Every year, if the market drops and you go down and you don't get any gain on your money, but your insurance value goes up and it goes up and it goes up. And now you're 70 years old, 80 years old, expecting to have this big payout. Well, that was eating into the value of the contract because it had to get paid from somewhere. That money, like Hans was saying, had to flow and had to be utilized, and the input and the output in that product had to happen. So it starts to cannibalize itself. So there's no guarantees. The other big problem with it is that they can change the terms whenever they want. So these universal life, these IUL products came out, a few years ago, and they would give these, the market was roaring, and they give this 12 and 15% cap rate. So what that meant is if the market does more than 12% for the year, they'll pay a 12% interest rate on the cash value side of that. 3 years later, they changed the terms and there's nothing you could do about it. And they lower it to 6 and 7.
Yeah.
So you had these amazing projections of what this product was going to do and how you have no control. So what you've essentially done was you've gone to an insurance company, and all insurance is meant to take the risk away from the person or the thing they're insuring, right? You're transferring that risk to the company by paying a premium.
Right.
They transfer it right back to you.
Yeah.
By putting it into non-guaranteed elements of the market or of the policy itself. So we think it's a problem. I would never use it for this process.
And you're blurring the lines of what we're trying to do. Like if we're going to simplify it, Brian and I focus on protection and saving, and you, Scott, focus on growth. And those are all three things we all need to be doing, but we don't want one product that tries to do all three of those. And so it's kind of, they sort of had to meet market demand with some of these products as they were rolled out. And so people said, well, this is a little too rigid, this whole life fixed premium. Maybe I want to be able to pull some levers and maybe not pay as much some year. And so they said, okay, here's a universal life contract. You can pull some levers and reduce the death benefit, so your premium goes down this year. Okay, that's cool. And people said, well, I want a little market exposure. So they said, all right, well, here's the same thing, but we'll tack on some market exposure. Well, as you do this, there is a way that an IUL could work, but it requires annual review of the cap rates, annual review of your funding. It depends somewhat on market performance. And so if you have that product and you're not getting a call annually from the person who sold it to you saying, here's how much you funded it, here's what the cap rate is, here's how the market performed, let's review because we need to game plan what you're going to do next year. I've never yet come across someone who has that product who has ever gotten a call back from their advisor.
Right.
Because the advisor doesn't understand, because these are very easy to sell and they typically come from these kind of turn and burn chop shops of like, hey, this looks great. People want investments. And so we're blurring these lines here. Like I like crypto, right? But I don't want my wife's security of if I die, replacing my income to be tied to the price of Bitcoin. Like when I want to grow my money and I look at my growth assets and I look at real estate, stocks, retirement plans, crypto, all these things. And a lot of this, like we'll categorize all those as like your specialty. Well, I want those things, but I also want, if I die today, I don't want the fact that Bitcoin is now down like 10% over the course of 24 hours. I don't want my wife's security and my children's inheritance and the future estate that I'm setting up, long-term thinking, to be tied to these things that are the risk that I'm taking, right? I want my protection and my savings to be contractually guaranteed, and I want my growth to have higher potential, but obviously that comes with the risk that I'm taking. And like I want very distinct lines here. With the whole life contract, it's the optimal vehicle for the protection and savings components. I don't want to inject any market growth. I get growth in there, I do, and we can talk. That's more specific. And that's what we talk about on our podcast a lot. But I don't want the market exposure, and that's what you're getting with this IUL is like, hey, this IBC thing looks pretty cool. Can I do that and get a little market exposure and get maybe some more growth? Well, okay, sure, you can, but you're reducing the guarantees. You're watering down both sides of things. Like,
it's like I've said to you, Scott, one day we chatted about this a little bit, and it's like the El Camino. Like they're trying to combine two things, and it really sucks at being both combined. Like it's not a good car, it's not a good truck, and so for this, we're trying to combine growth and protection. Or I mean, I'm sorry, savings and protection, and attach growth to it, and it really doesn't do a good job of either one of them.
But just like those illustrations that never come to fruition, it is sexy to look at. That El Camino, right?
Really, really good. And like Hans said something, and the problem is, like he said, that you need to have an annual review with your advisor, but you also have to first assume that your advisor knew what they were doing when they set it up, and they're going to know what they're doing next year with that. And I've had this argument with people like, well, you just have to know how to structure it. If it's structured right, it's better, is what they'll say. Or down the road in 30 years when that insurance gets prohibitively expensive, you have to know how to lower it and what levers to pull. Well, what if you're dead in 30 years, Scott, and you were my IUL advisor?
Yeah.
And the next guy doesn't know what to do, and neither do I.
Right.
If like a whole life insurance contract, if we don't even structure it properly the way we do for infinite banking, it's going to work 100% guaranteed. And if I write a contract for you and I die tomorrow, all you got to do is read the contract.
Yeah.
Nothing's going to change for the rest of your life. Like we educate people to have a good understanding of what the contract says, but my absence doesn't change the contractual rights of the policy, and none of those levers are going to change over time. So it will work. It'll work with me. It'll work without me. It'll work without you even understanding what levers to pull.
Yeah.
It's just going to work. It's guaranteed.
Well, and that's what I, even just going back to my old military experience, I know you guys know I'm an infantry guy, so you're used to intellectually and physically looking down on me from the sky. But even for us, everything would always be about task and purpose, right? And I'm a huge fan. I mean, all my clients know I'm always talking about, hey, we got to try to keep things simple. The draw in the financial world is always trying to manufacture complexity. And so I think what I love about what Hans was saying is quit blurring the lines. Here is a clear task and purpose for this investment account. Here's a clear task and purpose for this policy. It's to provide a death benefit in the short term, and it's going to replace what we do for savings and financing. And, when we can bring that clarity for clear task and purpose and not blur the lines, almost always you're going to get better performance by turning things loose to do what they were designed to do. So I really love that, that comment around not blurring the lines and keeping things simple. So now
like the Rangers are great. They're really good at what they do. We want to have Rangers doing what they do. And also submarines are great for a different role, but you don't put the Rangers on the submarines just because they're both appealing and they're both good things. It's like, they have totally different missions.
Yeah.
And it's like, if I want what the Rangers do, I want the Rangers and not a bunch of nerds on a submarine. But if I want what a submarine is doing, I don't want a bunch of like jocked up Rangers on the submarine. Like that just that makes both things worse.
They're going to break everything anyways. You know that.
Yeah.
So let's just kind of take a step back then. I appreciate a lot of the details there. And, hopefully we'll be able to do this again and go through different examples and unpack some things in a little bit more detail too. But I just maybe wanted to talk through verbally an easy case study, right? So let's say I'm just getting off active duty, finished my 20 years, and I just got hired by American Airlines. We'll pick at what you got going on over there, Brian. And I'm an FO, and I got 2 years under my belt, and finally getting to the point where I'm starting to make very healthy six figures. I want to upgrade eventually, but for right now, I'm just trying to build some seniority and get used to the company and the flow and all that. But I do find myself with a couple $1,000s a month extra cash flow. Right now, it's just going to the bank account. Eventually, wife and I are going to want to remodel the kitchen and all that kind of stuff, but it's kind of on the horizon. So what would somebody like that expect to have a discussion with you guys about what do we do with that cash flow and what is it going to unlock for me?
Well, one of the first things we would talk about is going all the way back to the beginning of this discussion. You said, you talk to guys and they say $20,000 a month hits the bank account. They spend 8 and you go, so there's 12 remaining. And they say, no. All right. So then you don't spend 8, right? So we would look at what are your spending habits? Do you unconsciously spend money and try at some point to consciously save money? Or are you unconsciously saving money and choosing what your spending numbers are? Because we can figure out a lot of how to structure this and what to do with this and if this fits your life just by having that flip script of what most of us do, which is unconscious spending. From there, we do an order of operations of protect, save, grow. Now, whole life insurance satisfies 2 of those in one. It's a part of the protection element in your life to make sure that we don't have wealth get destroyed by an unknown event coming up, and there's other protection components you need in place, but that one satisfies your economic life value and it has the savings component in. So it combines those two. And we would look at the economic life value of a person, which is basically, if I break it down real simple, I could say, how much do you make right now? How old are you? Subtract your age from 65, because the actuaries of the company are going to look at a normal working career of an adult in America. So let's just make this guy 45 for easy math. 20 years remaining to work. He makes $200,000 a year. His economic life value, 200,000 times 20 is 4 million. So we would look at that and say, especially if we're speaking with this guy and you said he's married, if he should walk off this earth tomorrow, are you comfortable with the $500,000 of insurance the company provides, or the $750,000 or whatever? How long is that going to last you when you're used to living on 200,000? So how can we combine this element into creating a better protection, because that is a disaster in her and their children's lives? So how can we replace your income that you were expecting to make and build this savings component to start taking over the finances in your life? And there should be room. So that'd be step one of just the discussion we have.
Okay. And then, so I start putting money in. Hey, we align on, hey, we're going to do this much term and then this much whole. And then I start putting money in. Obviously the term is what it is, but I'm building up this cash value. How far until like how long do you think it takes until that really starts to get some horsepower to it? Because obviously some of those early premiums, I'm putting in our front loan, the cost of insurance, but then it's going to start to grow. So, I'm just trying to think of that person who's maybe like, oh man, I got to buy a car in 2 years. What does that look like? You know what I mean?
I had, within 6 months of starting my policy, I had borrowed. So I purchased rental property, and I used a policy loan. I used my policy to cover all the down payment and closing costs. And I acquired a cash flowing rental property within 6 months, because Brian talked a little bit about it earlier. How there's the way that we front load these and structure them. There's the component of your premium that is going to be analogous to a mortgage, where it takes a long time to build equity. There's going to be another component of your premium that's going to be more analogous to a principal only payment on your mortgage, which generates equity immediately. The way we structure it, we can get a large, 70% of my annual premium goes directly into, and I want to be specific here. I don't want to misspeak. I'm still purchasing death benefit with this, but the type of premium generates cash value immediately. And so 70% of my annual outlay is immediately available as cash value that I can borrow against. And that's how I had a rental property cash
In
flowing
year one.
in year 6 months in.
That's not set. No, just I want to be clear on that for anybody that's hearing about this for the first time. That's not 70% every year. So now combine the two statements, Scott and Hans, that you both said. Scott, you mentioned that the cost structure of this whole life insurance comes in the front couple years. So it's 70% for Hans in year one. It's going to be more than that in year two. Even more of it is going to be like an equity in year three. And usually by about, I can't promise this, year 4 or 5, every dollar that flows into the system, so all of his premium or all of my premium, is now available in the form of cash value. And then beyond that, it's just more and more and more. So, at year 10, let's say, if you put $1 in, you might have $1.10 available.
Wow.
So if you're putting $50,000 in there, it might, your contractual value, the cash value might increase to 55, 57, 58,000 that same year. So it overcomes that early 30%, I'm going to call it cash drag, that Hans kind of mentioned there, over time. And just a few years in, all the money that flows in. So that goes all the way back to what Hans was talking about. Like, capital is going to flow into your life and it's going to flow out of your life. Ultimately, he's going to capture all of that capital that came in into these contractual value, or into these contracts, and have access to that to utilize.
And I'll address the challenge that I'm sure people have when you hear, okay, well, that's cool. You put in $50,000, but you only had $35,000 available in year one. Well, yeah, it sounds cool that you're doing stuff, but what about the other 15? Well, if we're thinking long term, and the comparison is always it always happens to be a 401k. It's always a qualified plan. That's because that is the first bucket that people think of. And so you could put money into a 401k. You still have a liquidity drag, in the sense that we're not putting into a 401k to have money to spend today. Inherently, with the entire purpose of it is to spend in retirement.
Yep.
So if you're in your 30s, we're thinking 3 decades from now. And if you look at that growth chart that is projected, you're looking at a number that requires a decade of fairly stagnant, still growing, but the eye-popping numbers that you're seeing when you're saying, hey, look how much money I can make in my investment. Why would I do this? Well, those numbers also require that entire amount to be in the market, get exposure, getting those gains, hopefully, the entire time. And so theoretically, I guess you could reach in and take 100% of it out. You could do that, but your intention for that money also is for down the road. Right. And so it's, if I put 50,000 into my investment account, that's going to grow and get this huge nest egg down the road, and I want to take out 30,000, in my case, that's what I put as the down payment for this rental property. I could do that, but I've just reduced my principal down to 20. And so that I've lost down decades of that 30 compounding for me. When I leverage, that's the difference. I talked about liquidate versus leverage. When I leverage my policy, I never reduced my cash value. It's still growing, guaranteed. It's still earning dividends for me. I took an outside loan, other people's money, OPM. We all know that in the real estate world. I use OPM, the insurance company's money. I leveraged my cash value, and then I deployed that. So I haven't spent a dime on this rental property that is cash flowing for me. And so that's kind of maybe perhaps more in the weeds, but it's the idea that whatever you're comparing it to inherently also requires that time to grow. And so, yes, I have a quote liquidity drag, but so does my brokerage account if I'm waiting for those future nest egg returns.
Right. No, and that's what I love about, your guys' podcast, and a lot of what you guys teach too, is how this fills that save, that need for save, and when we think about spending 34% of our income on financing over our lifetime, and you flip paying that out at 4 to 6%, and instead of paying that out, all that capital, all that compound interest stays in our house. You significantly move the needle. Like I tell so many of my clients, hey, when we make these little tweaks in your portfolio, 1, 2, maybe even 3 years later, you might not know the difference. If we're able to shift the returns by a couple percentage points, and you compound at 10% instead of 8%, over a few years, you don't notice the difference. But if you run it over 20 years, it's a 7+ figure difference in your retirement. It's significant.
Yeah. And pilots get that inherently.
Yes, for sure.
If I fly from San Diego, where I'm at, to Pittsburgh, where Brian is, and I'm a degree off course, that's not going to really impact us when we're flying over Arizona. We'll still be relatively in the range. But if I hold that course, I'm not going to make it to Pittsburgh.
Yeah, you're going to be in something like it. Yep.
So
and it's the same thing. It's the same system. Speaking to pilots, is that these contracts get more efficient forever, just like an airplane. So if you took off in a heavy airplane, a 747, it's not very fuel efficient when it first starts over the pond, but by the time it gets to the other continent on the other side of the world, it's extremely fuel efficient in comparison. Yeah. So these things gain efficiency over time. The impact early on is greater to the efficiency of the policy because of some of those expenses of paying for the insurance that you'll have the rest of your life. Yeah. But yeah, so back to your question, because we kind of went all over the place there, but that guy who wants a car in 2 years, he may be able to be doing it, but Nelson's number one principle that we stand by is to think long term. We're thinking multi-generationally if we can. So the solution is probably there in 2 years, depending on the amount that he capitalizes into a policy, but it's definitely there going down the road.
Yeah.
And he's going to buy another car in 5 more years, and another car in 4 or 5 more years. And he's going to buy an investment, and he's going to buy another house, and he's going to pay for kids' college and a wedding. And all of those things are going to happen. So to focus on 2 years out is a little bit of missing the mark, although it's probably still very, very much possible for him to take advantage of that.
Well, I know we're kind of getting close to time here, guys. So just kind of as we wrap up, a couple final thoughts that I have, and then I'll kick it over to you guys, and then I'll ask how to get a hold of you on all that. But one of the things I think about that I see frequently is many of our pilots are underinsured, especially, so many of them are making significantly more than they ever thought they were going to make. And they are, if you look at what the life insurance benefits are for the pilots, I would say those have not kept up with the income increases over the years. And so I frequently see what I would call a gap. Like, hey, if something happened to you, you are not on track. I mean, your spouse and family is not going to have nothing. On average, you see $1 to $2 million coming from the company, but that's not typically even getting to half of what most of these guys' earnings are worth for the rest of their working years. So, I think that's one opportunity to have a discussion with you guys for sure. And I think the follow-on discussion that's dovetailed right in with that is, how are we using our savings, and how do we start to flip the tide from paying interest out to compounding it on our behalf for the rest of our lives and really becoming our own banker. So, with that said, obviously for a lot of my existing clients, we'll be facilitating introductions, and as they watch this, they'll ping me and I'll get them introduced to you guys. But for maybe some of the folks in the broader audience, how do they find you guys?
Yeah, you can find us at remnantfinance.com. You can look up our podcast on all the major platforms. It's Remnant Finance, also on YouTube. You can email us at info@remnantfinance.com.
Perfect. Okay. Awesome. Well, guys, thanks again for coming on here today. I really appreciate it. I'll turn it over to you guys for some closing thoughts, and then I'll wrap us up.
My closing thought, based on what you were just saying, is remember that you are your most valuable asset. When you sit down with the client, Scott, and you look at their entire asset allocation, most of the time, I'm guessing that when you rack and stack all of your assets by value, we're probably not often thinking about the fact that you, as a captain at an airline at 45, making $200,000, easy, right? You have 20 more working years. That example that Brian gave, you're worth $4 million. Yeah. Your biggest asset is the fact that you reliably go to work each day and provide 6 figures of income, reliably. And so if we're not capturing that value, if I had died while I was in the Navy before I had discovered this, as a 25-year-old, if I'm worth $4 or $5 million because I have such a long working horizon ahead of me, I would have left my wife $400,000, which is the SGLI, the military group life insurance. It sounds like a nice check until you realize what my wife is missing out on 4 decades of my earning potential. So you are your most valuable asset. But most people, that is they have their car and their house insured to 100% replacement value, but their life is insured to maybe 5%. And if you died right now, think about what your wife and your children would be subjected to. And does your wife know that you've made that decision for her, that if you pass, your income passes with you? Or have you thought through it, prepared for that inevitability that you will die one day, and made sure that whether you survive or not, their lifestyle doesn't have to change?
Yeah, you're walking around as a Lamborghini, insuring yourself as a Chevette. So something to think about there. And I would also, off of what you said there, Scott, too, it's not always about the rate of return. A lot of the fact is what you can keep. And by financing the things in your life, it's about what you retain in the money. And that's going to create a massive economic tailwind, just as much as chasing the rate of return. The rate of return is great, but how much do you keep in your life and in your personal economy can be just as powerful. And then if you put those two together, if you can retain more money and you can figure out great ways to grow it, which is your job, you're doubling that tailwind.
Yes.
It's what most of us are doing is we're fighting that. We are financing and sending all our money out to a bank and trying to get a greater rate of return, and we're just flying into a headwind.
Yep.
So let's create a tailwind around that and retain our cash, retain our capital, and grow it.
I love it. Well, thanks, guys. First conversation of many to come, I'm sure. Look forward to continue to grow the content here and grow the information. And, like I tell all of our folks out there, better data leads to better results, better retirement. Okay. And these guys are really providing a lot of better data for us out here in terms of this protect and save aspect of it. So reach out to them, and we'll look forward to seeing you guys out here soon.
All right. Thanks a lot, Scott. Appreciate it.
Thanks, Scott. Cheers.
All right. Cheers.
Good chatting with you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.